The focus of this chapter is going to be specifically related to calculations related to our defined benefits program. So we're going to spend most of the time this evening basically talking about some various concepts related to a defined benefits program. And once we go through that, then we need to sort of understand some of the calculations. But you need to understand the concepts before we actually move forward with the other material. Okay, so what are pension plans? Pension plans are designed to provide income to individuals during their retirement years. Okay, so the idea is, and we're talking now about all pension programs. So in all pension programs, what we're looking for is a program in which once you're too old to work is you're not starving. Okay, and certainly we know that you're not going to be able to survive based upon what you collect from Social Security. So the idea is that what we want to do from an employee perspective and certainly from an employer's perspective is we have a responsibility to our employees. Basically it's a social or moral contract. Is basically it goes like this. Is an employee gives the best years of their life to the employer. He works hard, she works hard for all these years, and then when this person is no longer able to work, the company will then provide benefits to this individual. Okay, so a pension plan is basically accomplished by setting aside money during the working years, and then once the person is retired, then these funds become available. Pension plans provide employees with a degree of retirement security and often enhances productivity, reduces turnover, satisfaction, union demands, and so forth. So the idea is that if you are in a vested program, you're not going to be very reluctant to leave because you want to maintain these this vesting for as long as possible because it really does create value for you as you grow. Okay, so there's a couple of types of pension plans, and the easiest pension plan is what we call a defined contribution. Okay, so defined contribution essentially is that, and we'll talk about these in a minute or two, but we're talking about things like a 401k, a 403b. Some organizations, if you're government or possibly a not-for-profit, is you also have the option for a 457, but the idea is that the employee contributes out of his own funds, his or her own funds, to the pension. These are pre-tax payments to the pension, and it's very possible that the employer then contributes to this pension also. This money is contributed to the pension plan. It's managed by a fund administrator. And then once the employee is vested, usually at 5 years, the employee contribution remains with the employee. The employer's contribution remains with the employee. And certainly anything that the employee contributes is his or hers that's within this, pension manager. Now when you are then retired, then you withdraw from this money. You withdraw this money, and that money that you withdraw is taxable. So from a tax perspective, it certainly provides value to the individual, and then also provides money post-retirement. A defined benefit. Defined benefit is where it becomes very complicated. Usually you see defined benefit in not-for-profit organizations, some not-for-profit organizations, not all, government organizations, and usually if there is a union, the union essentially is pushing for a defined benefit plan. Now, the defined benefit plan is highly complicated, and we'll spend a lot of time talking about it here. We'll actually talk a lot about it from a number of perspectives as we go through these assignments, but the idea is that what we are promising in a defined benefit pension plan is a promise to pay a fixed retirement benefit. So we're promising as the employer to pay a benefit that's monthly until the person dies. This pension is based upon the formula of the number of years, the annual compensation, possibly age, and then some sort of factor that's being used here. Okay, so again, defined contribution, think about this, 401k, 403b. Defined benefit is where the risk is going to the employer, where the employer needs to provide this monthly benefit post-retirement. So defined contributions and the defined benefit plan is, in a contribution, is defined by the agreement. In other words, how much the employer contributes is based upon the agreement. The employee can contribute to this also, and the employee certainly should be doing this because the bulk of the money that he or she has at retirement is going to come from his or her own contribution. Okay, and the risk is on the employee. So if the employee manages the fund poorly or doesn't contribute enough or does early withdrawals, so there's a lot of things that the employee could be doing that are detrimental to the retirement plan when the employee finally retires. So you need to understand that in the defined contribution, the risk is on the employee. In a defined benefit plan, again, which is the focus of most of our discussion, is the plan is defined by the employer. The employer needs to fund this plan, and the employer essentially has a number of risks from a number of different perspectives in terms of the management of this plan. Defined contribution promises a fixed periodic contribution. So we're not talking about a periodic withdrawal, but a contribution to the pension plan without further commitment in regards to benefit amounts at retirement. So again, if the employee doesn't manage this fund appropriately, the employee doesn't have any money at retirement, that's not the employer's problem, that is the employee's problem. Variations of this plan, the employer contributes a fixed percentage of the employee's salary. There are things, again, like a thrift plan, usually what we see is a 401k or a 403b. 403b essentially is 401k, but a 403b is for a not-for-profit organization. Contributory plan, the employee makes contributions in addition to the employer's contribution. The amount of the contribution is basically defined by the IRS code, and you have the additional, whatever it is, $6,000 a year. Once you reach 50, once you reach 50, you can make some additional contributions. When the plan is linked to the amount of contribution, the company when plan links the amount of contributions to company performance, labeled as profit sharing plans, incentive plans, 401k profit sharing plans, and so forth. So it's very possible that if you work for a for-profit enterprise that has publicly traded shares, is that you might be bonused through the pension plan through a number of shares. And again, it could be profit sharing, could be otherwise. All those, as they go into the 401k plan, are going to be tax-free to you, but as you withdraw this money post-retirement, there's going to be a tax associated with this. For a defined contribution plan, a very simple transaction, and the very simple transaction is that you essentially have a pension expense, you're paying cash, and again, the cash is going not to the employee, but the cash is going to the plan administrator. So any pension plan, the money is not within the company, the money is within a plan administrator. So this could be Dreyfus, this could be Fidelity, There's hundreds of plan administrators. These are the people that are managing the plan. So when the employee pays a pension expense, the employer is paying this money to the plan administrator. Okay, so let's now talk about a defined benefit plan. Defined benefit plan, the example here is an employee retires after 30 years of service with a final salary of $100,000 and annual benefits that are calculated as 1.5 times the number of years worked times the salary. Now this 1.5% essentially is driven by the actual plan. Okay, so the organization that I work at, I teach at a state university in New York, is we use the 1.5% times the number of years worked, unless you've actually worked there for 20 years, and then it converts over to 2%. But 1.5 is probably a very standard rate. So basically what we're saying here is that what this person is going to get after 30 years of service is $45,000 a year. Okay? Now, just kind of think about this, is 30 years ago when this employee started working, is the organization then started to create a liability. Well, this liability didn't start or wouldn't start until the employee retired 30 years later. And then the question then becomes is, well, how long does this person get this money? And the answer is they get it till they die. So the risk here is the fact that this person may live for 5 years after retirement, or he may be one of these people that lives to 112 and live 50 years or whatever after retirement. So the issue becomes is it creates a tremendous amount of record keeping and planning and management, because you're basically dealing with a single employee. Again, if you look at this person, he works for 30 years. Let's say he lives for 20 years after he retires. So we have a sort of a record of this employee for a 50-year period. That's a lot of work in terms of managing this, and a lot of unknown risk as you are attempting to manage this process. Okay, so absolutely. So some of the uncertainties is the rate of return on plan assets. Plan assets are the assets that are within the plan administrator to cover the expenses, the number of employees eligible for retirement, the age at which the employee chooses to retire, life expectancy, inflation rates, future compensation levels, and interest rates. So all these things create uncertainty, and hence we have this whole issue related to an actuarial. An actuarial is a professional trained in a particular branch of statistics and mathematics, hired by the organization to assess the various uncertainties and to estimate the risk to the organization in regards to the plan. So what the actuarial will come up with is an obligation. So this obligation doesn't quite act like a liability, but it's very similar to this, and this essentially is all these variables in regards to the plan. You notice it's an estimate. It invariably deviates from actual outcome. Again, think about all of these things that we need to kind of consider. Okay. Now, we're going to use some very specific terms. It's really important that you understand that we're using these terms for a very specific meaning. The first term that we see here is, let me see if I can actually draw a highlight on this, is our, boy, that's a little dark there. I'll put it, underline it here. Pension gains and losses. So pension gains and losses is, and again, one of the things that we need to understand is that we have the liability, which is the pension, what we're going to define as the PBO, but we also have assets. These are the assets that are embedded in the plan administrator. So as we contribute to the plan administrator, money goes up. As the plan administrator pays benefits, the money goes down. But the idea is that not we, meaning the company, but the plan administrator is investing these funds. So we are going to receive gains. Hopefully we receive gains. There might be losses, and in fact some of these losses can be fairly significant. Just kind of consider the events that occurred at the end of 2007 when the market crashed, and there were plans that had $100 million losses just from that, that 6-week loss that occurred at the end of the year. So the issue becomes, is pension gains and losses are a part of the formula. Okay? And now I got to figure out how to, here we go. Okay, so I got this. Okay, so the next piece that we want to look at is hang on here. So key elements of defined benefit plan is the employer's obligation to pay benefits. Plan assets are the assets that are held by the plan administrator. And when we're talking about pension gains and losses, we're talking about gains and losses specifically related to these plan assets. There are expenses, and we'll talk about these expenses next. So basically what we're looking at is, in this case, we're looking at why companies are moving away from defined benefits and moving towards defined contribution. And the exceptions are basically government entities as well as union shops where it's very difficult to make these changes. And the issue becomes is government regulation is very difficult. It's costly to administer. There are very significant risks related to defined benefit plans, and there's a shift among employers from trying to buy loyalty to attract new talent. So the issue becomes is we're not necessarily looking for, organizations are not necessarily looking for these people to be with the organization for a long time. They may be looking for essentially these employees that are sort of coming and going over a couple of years. And in fact, that's not necessarily a bad thing. From your career perspective, you're not necessarily looking for an organization that you want to stay with for the next 30 years. You're probably looking for, as you're moving through your career, working 4 or 5 years here, then going somewhere else for a couple of years, and going somewhere else for a couple of years. So a defined benefit plan may in fact not meet your needs because you're not going to be there for 30 years. Defined contribution may in fact be more valuable. So let's talk about some of these definitions. So we've talked about the gains and losses. So gains and losses are related to what's taking place at the plan administrator level. So what's taking place at the plan administrator level is they're investing the money. Hopefully they're making a gain, but they very easily could actually have a loss. We'll talk about prior service costs in a few minutes, but basically what we're talking about related to prior service costs are where there are changes in the program, and we need to devise a means by which we then allocate these costs to the system. Okay, so what I really want to focus on are these items right here. Okay, so these items right here. And just kind of, we're going to walk through each of these sort of incrementally. Is the first thing is the service cost. Okay, so the service cost is related to the fact that every year, every incremental year that you work for the organization is that you have one more year of service. So we use this formula. It's the number of years times the percentage, say 1.5%, times your annual salary at retirement, $100,000, is the amount that you're going to get as the benefit. Well, if last year you were there 20 years, now this year you're here 21 years, so that incremental 1 year of service is going to increase your benefit. So from a service cost perspective, this is what is actually taking place with the increase in cost. Okay? Now, you notice the next item is interest. And it's actually going to be, we'll show a table in a few minutes, but basically what we're looking at is we are paying on an annual basis or a periodic basis towards an annuity. That annuity stops upon retirement, and then that annuity then needs to be large enough so that as the benefit is paid to the employee, that essentially the entire annuity is wiped out by the time of the theoretical death of the employee. But the idea is that every year we are 1 year closer to retirement. So incrementally, we have one less year to accumulate the funds. So what we're talking about here is service cost is specifically related to the number of years worked. So this increases, thus increases the formula. Interest cost is the actual cost based upon the discount rate that you're using that essentially is defining the incremental steps in terms of getting to retirement. So we have one less year of time to have that money available at retirement. And then the return on plan assets, we want to make that differentiation between return on plan assets, essentially is the expected return on the plan assets, and then what we have is losses and gains. So we're going to make this distinction here in the sense that when the gains and losses are greater than a sort of the expected return, it's very possible that we're going to amortize some of this. And the reason that we want to do this, based upon the prior service cost and the significant losses and gains, is we're trying to smooth this process out. Again, just kind of visualize that what we're talking about is we're talking about a year span, or maybe a 50-year span in terms of the time the employee starts work, maybe 50, 60, maybe 70 years to the time payments are stopped because of the employee has died. So significant gains and losses from 1 year to the next may not really mean things in the span of a 70-year period. And again, just kind of visualize what took place in 2007. We had that significant loss. It just was unbelievably detrimental to pension plans. But 5 years later, the market has rebounded. So if you took that loss in its totality in 2007, we would be sort of a whipsaw action related to the pension, which really sort of loses the point related to what we're attempting to do. Okay, so let's continue on here. So interest cost is related to, again, the financing aspect, and again, the fact that we are 1 year closer. Let me close these things off. So we're going to measure the pension obligation from a couple of different perspectives. And let me just kind of stay out, sort of out in the front here, is what we're interested in is the PBO. Okay, so what is the PBO? Well, the PBO is the projected benefit obligation. The projected benefit obligation is the actuarial's estimate of total retirement benefits at their discounted present value earned so far by the employee, applying the pension formula using the estimated future compensation level. Okay, so let me just kind of talk about it from this perspective. So what we're talking about is, let's say the factor is 2.5% of salary. Let's say the employee has 10 years of service and he or she is making now $60,000 a year, but what we're projecting at the when he or she retires is we're projecting an annual income of $100,000 a year. So the formula for the projected benefit obligation is current years of service times the factor, the 1.5, times the estimated future compensation at retirement. And what this does is this means that that estimated future salary at retirement stays stable from one year to the next, assuming there's no hyperinflation or other issues. But the only things then that change is from this year to next year is the fact that we now have one more year of service, and we are now, so that's your service cost, and we are now 1 year closer to retirement. So we have the service costs and the interest costs, but we don't have to contend with changes in salary. So what we're doing in regards to the calculation is we're using this projected benefit obligation. Now, accumulated benefit obligation is the same thing, except for the fact that you're using the existing compensation level. So the accumulated benefit obligation would be, if the employee terminated today, what is our obligation? Because if they terminate today, we're not concerned what they're making at retirement, because what we would be looking at is, let's say they have 10 years of service. Let's say they're 40 years old, they have 10 years of service, and their expected retirement is 65. So there's now, 25 years to retirement, but they have 10 years of service, they're making $50,000, and the factor is 1.5. So what we're saying here is the fact that this person now has an expected retirement benefit when he or she retires 25 years from now, based upon 10 years times 1.5 times $50,000. Let's figure out the math on that. Which again, kind of think about from the employer's perspective. Now we have an obligation that doesn't actually come into starting payment for 25 years. So the management of this is very, very difficult. The only thing that we'll talk about vesting is, vesting essentially is that point in time where when you quit, you still get the benefit, kind of what we were talking about, the 10 years. Usually vesting occurs at a 5-year mark, although in some newer plans, you actually have to be around for 10 years. But again, PBO is the number that we're looking for, and PBO is looking at the future obligations. We've talked about the accumulated benefit obligation. The vesting is usually, again, we're vested at 5 years. If a person quits prior to 5 years, there is no obligation to the organization. There may be some money that needs to be paid back. Sort of depends upon the plan. The only point that we'll make here is the Pension Benefit Guaranty Corporation is pensions essentially are guaranteed by the U.S. government. Okay, so if you can remember all the problems related to General Motors, one of the things that in terms of the debate that nobody really talked about was the fact that if General Motors went under, well, the government has the obligation to pay all these benefits anyways. So why don't we just accept that and sort of try to make the company work? Okay, but again, that's the point. Is the PGBC essentially is guaranteeing the obligation. It is a essentially basically an insurance policy, and it's financed by the employer. So the projected benefit obligation, again, the key thing is that we're looking at the future benefit, future compensation, less reliable, but if we do it correctly, it's faithful to what it is that we're trying to do. And we've gone through this calculation here. Now, I think we've kind of gone through this. Okay, so the question here is, the projected benefit obligation is best described as the present value of benefit accrued to date based upon future salary levels, present value of benefits accrued to date based upon current salary, increased in retroactive benefits at the date of the amendment of the plan, and an amount of the adjustment necessarily to reflect the difference between actual and estimated accrual returns. Okay, so hopefully the answer is A, because what we're looking at is we're looking at future salary. Okay, so this is kind of what I was talking about in a few minutes ago, and so what we have here is we have a scenario where that the employee is starts working on 2005. The anticipated retirement date is 2044, and we're expecting him to live for 20 years. He could live for 50 years, but we're expecting him to live, or her to live, for 20 years post-retirement. Now, the issue becomes is we've got two different things here. And this is one of the most fascinating things about this process, is what we're looking at is we're looking at three different things, okay? So the number one is the employee estimate earns as of 2014, so that's where we are right now, is 1.5 times 10 year times $400,000, so he's making a lot of money, which is $60,000 a year. Okay, so so $400,000 is his projected. We'll say his for simplicity, but that is the estimated salary in 2044, 30 years from now. So what we're saying is that we are estimating a liability of $60,000, or that we're estimating that as of right now, there is a liability which is an annuity of $60,000 a year for 20 years. So $60,000 a year using the annuity factor of 6% means that we need to have, as of 2044, $688,195 in the bank. Okay? Now, as of today, what that means is we then take that number of $688,195 and then define a present value of that. So what we're saying right now is that if we expect to have $688,000 available in 2044, then today, using 6%, is that we need to have, right now, set aside for this person $119,822. Okay, so you notice how this is a present value of a future amount. 3 is a present value of future amount. 2 is a present value of an annuity. And the idea is the annuity is set up so that we are paying principal and interest at $60,000 a year back to the employee, so that the idea is that when he passes away in 2064, that we have spent all the annuity. So the annuity is what we're looking for 2044. So to get $688,000 in 2044, we need $119,000 in 2014. Why is 20 years? No, it's 30 years. Oh, 2 is 20 years. Well, you're talking about this number right here. Well, because we suspect that this person is going to die, our actuarial has told us that the person is going to die in 2064. Okay? So that's why it's 20 years. Okay? And that's usually the answer there. So this number here of 30 years is he or she is going to retire in 30 years. So we have 30 years to accumulate this amount. And once we've accumulated this amount, and again, the amount of 688 is the amount that we need to pay down $60,000 for 20 years, assuming the amount that remains unpaid is getting a 6% interest. So we need $688,000 to pay $60,000 for 20 years. Okay, but we don't need that $688,000 today. We need that $688,000 30 years from now. So that's where this number comes in of 119. That actually provides a basis. So this is a brief introduction. I'm going to provide some additional guidance in terms of some practice problems. Again, I've got a couple of videos that I'll provide, and I'll kind of try to walk through a couple of the problems through a YouTube video to sort of get a sense of these issues. But within this 1-hour presentation, what I wanted to kind of come up with is getting you to understand this defined benefit plan. This defined benefit plan is really the focus of our attention in this program, and through this defined benefit plan, these are the variables that we're looking for. Okay, so I thank you very much for your time and attention. In any event, everybody have a wonderful evening, and we will talk to you in 2 weeks.